Hi, all. We'll start in a few minutes. We'll give a few more people time to log on. For those of you who are new, not some ground rules, but here's the procedure. I'm going to go through a slideshow I already have presented. After that, we'll start hitting the Q&As. But if anybody on the team or anybody in the webinar has any questions now, start typing them in the Q&A section. I'll answer them when we're done. If you want the next couple of minutes, put any questions pertaining to just mortgages, give me a shout, put it in there. I'll answer it prior to going through my slideshow. But I'm going to give a few people a few more minutes to log on, get acquainted with the system. It is a newer system. So speak to you all soon, team. Hi, all. Okay. So welcome to Mortgage Mondays with Manny. I'm Manny. I've been doing this for a long time to give all the new individuals some background on myself. I've been doing this for roughly 23 years. I've had my hands in a ton of mortgages in the tens of thousands, whether it's myself or helping a lot of teams. But, tonight I wanted to go over one of the things that, Merchants Property Solutions does and does well is conventional loans. All right. We do the non-QM loans, which is also known as the bank statement loans, which is a different way of proving income. But now, I don't want people to lose sight that we also do conventional deals, whether you are a self-employed person, a W-2 individual, a 1099 individuals, you could use a lot of different ways you get your income, but it's all proved the same way, which I'll get into, which is full documentation. So with that being said, team, I'm going to share my screen. Okay. We are going to do a PowerPoint presentation. All right. So this is what is the conventional loan. Now, Fannie and Freddie, okay, Fannie Mae, when I say Fannie and Freddie team, I mean Fannie Mae and Freddie Mac. They are government-sponsored entities, but they are not government-backed mortgages. So take a look at that, team. Take a look. Hold on. I just want to move something real quick. Okay. So, again, guys, as you have questions, put them in the Q&A or put them in there. I'll answer any questions. So Fannie Mae and Freddie, read that real quick. Government-sponsored entities, but they are not they are sponsored by the government. They're not backed by the government. All right. So the Fannie Mae, FNMA, definition of a conventional mortgage refers to a type of mortgage loan that is not insured or guaranteed by a government agency such as the Federal Housing Administration, FHA, or the Department of Veterans Affairs, all right, a VA loan. Conventional mortgages are typically offered by private lenders such as banks, credit unions, and mortgage companies like myself. All right. So what are a few key highlights, you ask? Here are a few key highlights, team. So on any conventional loan, it's very rare. There are other ways PMI, but whether it's worked into the interest rate called lender paid mortgage insurance, whether it's paid up front, there is some sort of private mortgage insurance on all conventional loans. Okay. The most typical way, 999 times out of 1,000, the most typical way is a small monthly payment based on the loan to value. So for example, an individual that refinances or mainly buys a home because there's no anything over 80 LTV and a cash out. So any individuals that buy a home that are not putting down 20%, they do have PMI. Now, the monthly payment, the more you put down, the less that is. So to give you an example, somebody that puts down 15% is going to pay less somebody that puts down 10%. Okay. So that is one of the key differences. Again, the more you put down, unless it's 20%, the less your PMI. Okay. Conventional loans will have a max debt to income of 50%. When I say DTI 50%, that is the housing payment along with anything else that shows up on their credit report. If there's any garnishments on pay stubs or any judgments that they're paying off, which is very rare, usually they have to be paid prior to, or anything that it's encompassed into there, we need to see and detail and calculate that into their debt to income. Okay, that is very, very important. Debt to income is, makes or breaks a loan. All right, loan to value. We can go up to 97% on a purchase and a rate and term refinance. All right, and to elaborate a little bit on rate and terms, Fannie Mae, which is going to be big again, because rates are traditionally higher right now. They have a called a streamlined finance, which means your closing costs are cheaper. So anybody we're putting into a home now, we are letting them know, and you could let them know, hey team, we are, I let all my clients know, this interest rate's higher now. Yes, rates will go down. They have to. This is just the high end of the cycle. There's always a low end of the cycle. Once the rate drops enough and it's worth refinancing, we could do a streamlined refinance. What does that encompass? Sometimes no appraisals, not proving any income, a lot less documentation, and there is some rebates on the cost, but there is closing costs on a streamlined refinance. All right. Cash outs, max 80. So there's max 80% LTV on investment properties, team, on a purchase or a cash out. All right. Which leads me to the next bullet. Max 80% cash out on a cash out refinance. 620 minimum FICOs. There are seller's concessions, a max of 6% on a primary residence, 3% on an investment property. What's a seller's concession? I'm going to give you guys a quick example. A seller's concession is when the buyer of the property pays your closing costs. Now, it's common, but not in this market. It is coming back. Why is it not common in this market? It is a seller's market, as you all know. Now, what does a seller's market mean? That means most of the time the sellers are controlling the entire transaction, and they can be extremely choosy on the buyer that they pick. So, for example, 12 months ago, if you can ask for seller's concession, they went on to the next person in the 42 offers they got over asking. That's been going on for the past 24 months. So now seller's concessions are coming back. So again, what does that mean? Let's say Mr. and Mrs. Seller are selling the house for $200,000. You say, okay, sellers, do me a favor. The house appraised for $220,000. Sell me the house for $212,000, and the extra $12,000 that you're getting, pay my closing costs with. So it makes it advantageous for the seller to do this. Why? Because they're still netting that $200,000. They're getting an extra 12, but they're still netting the $200,000. That 12 extra thousand that they're getting, they're paying your closing costs with. So again, keep in mind it has to appraise higher. Seller has to agree to it, and it's written into the contract. It says sellers will provide a seller's concession of X, and it's done in a dollar amount. Okay. Next thing, I don't care who you talk to. Okay. Yes, there are different variations of documentation that's asked for. If there's anybody who's maybe a mortgage person here who wants to call me out, that's fine. You can. I don't know everything, but there is always full documentation of income. Now, that might be limited to what you do, how you do it, or how you get paid. So it might be different documentation, or I'll get to in a second, the desktop underwriter might ask for different documentation. Yes, sometimes you can get away with 1 year's tax returns. Yes, sometimes you can get away with a verification of employment only. Yes, sometimes you can get away with W-2s only. But at the end of the day, you still need to prove your income with either pay stubs, W-2s, tax returns. You're not using your bank statements, or there is no documentation of income on a conventional loan. Okay? They want to make sure you have the ability to repay. And that is something that came out, and it's written into Congress. It's a law. You need to show ability to repay a loan. That is what got us into the 2008 financial crisis with real estate. All of these stated income loans, these no documentation loans, the Nina loans that some people call it. It is, something that needs to be done. You need to prove income. All right. Always full diet. Now, must pass the desktop underwriting system. Yes. Any Fannie Mae loan must what gets called an approved eligible. All right. Unless the loan amount's a little bit higher, there is a conforming loan where it'll say approved ineligible only because of the loan amount. Yes, you could do a conforming jumbo, but it's ineligible because of the loan amount. Now, that is the end all be all what the underwriter is going to ask for. So, for example, once I get that desktop underwriting kick out, it may say, hey, this file scored really well. You only need 1 year's of tax return. Hey, this file scored really well. You only need to show me one pay stub and 1 year W-2. There is different variations. And once we get that documentation from my operations team, I will let the borrower know, hey, great news, you have some limited documentation. Or it may also say, hey, this gets an appraisal waiver. Again, they don't happen often in this market. Sometimes you get an appraisal waiver. Sometimes you do not need to get appraisals done on properties. Okay. And team, remember, I'm not seeing anything in the Q&A right now. There are a bunch of us on here. I don't know if you're mortgage experts. I'm not, but sometimes I am. If you have any questions, put them in the chat, put them in the Q&A. This way I can answer them when we're done. Okay. Put them in as they come in, team. I might not answer them now, but put them in as they come in. Okay. So again, must pass the desktop underwriting system. That is the end all be all on Fannie Mae mortgages. All right. One of the other caveats too, loan limits. Fannie Mae has loan limits based on the county. Okay. Some counties are high cost, like, Topeka, Kansas might not have as high as a loan limit as Manhattan, County of Manhattan does. Based on cost of living, based on the houses, based on the real estate. Hawaii has some of the highest limits along with Alaska. All right. Your bigger cities or your football cities are high cost. Sometimes you get surprised an area is not high cost, but the loan limits are almost $1 million on a single family on high cost areas, almost up to $2 million on 4 units. So you can do multiple units, team, and I'll get that into a minute. But loan limits are based on the county, right? And we always want to check our loan limits. So, for example, if somebody's telling you they're getting a $4 million loan in a conventional deal, 10% down, most likely not. That's a very rare deal. Not to say it can't be done, but odds are they have a kind of a special lender. Maybe they're a private client with their bank and they're making an exception. So, there is ways other banks will do it. But again, we're just on conventional. That would still be an unconventional loan. They just found a bank to do it. Last key highlight, the credit requirements of conventional mortgages generally have a stricter credit score and income requirements compared to government-backed loans. And when I say government-backed loans, I'm meaning VA, FHA, okay, USDA. To give you a couple examples of the big differences, FHA, you go down to a 580 credit score. All right. Well, the lenders, that's an overlay. All right. So you go down to a 580 credit score and a 55 debt to income. VA loans, you could do 100% financing and no mortgage insurance. So you just pay what's called a funding fee on VA loans. So those are some of the differences between a government-backed loan, government-backed meaning FHA, VA loans, and a conventional loan. All right. Now you ask, what are eligible properties? Here they are. So you could do a single family home. You could do condominiums, but the condominium must be approved by Fannie Mae. So there's two, when it comes to condominiums, and number 5, you see co-ops. So there's 2 entities approved. You as the borrower and the co-op and the condominium association as individuals. Okay. So they need to be approved as a business. You need to be approved as the borrower. They don't want to lend to a co-op board or a condominium association that doesn't know how to run their funds, because condos and co-ops always have a maintenance fees, which they'll be getting pretty hefty, always have maintenance fees, and they're getting more and more expensive every year. So they need to make sure that is being properly ran. Okay. Multi-unit properties. Traditional Fannie Mae goes up to 4 units. There are other Fannie Mae and Ginnie Mae and other things where you can do 5+ or a mixed unit, mixed use, but that's not something my bank does. We go up to 4 units on a conventional loan. Manufactured homes. You are allowed manufactured homes, okay? But they need to have 2 things. They need to be tied down to, actually need 3 things. Tied down to the foundation. I call them hurricane straps. That's the lingo that I used. But it needs to be permanently affixed to the foundation, noted in the appraisal. It cannot be mobile anymore. That's the first thing. Number 2, they have to have what's called a HUD tag, Housing and Urban Development tag, right? That's done upon being built. Very common. If it doesn't have it, we can't fund on it. All right. And third thing, depending on the type of property or manufactured home, sometimes they come with a title. Title needs to be surrendered to the local motor vehicle. This way they can't be moved. They can't do anything. All right. So if there's a title, it must be surrendered. Co-ops. Okay. Co-ops are a beast of themselves. Mainly in New York here and big cities, you'll see co-ops. Very rare outside of the country. But co-ops is a cooperative. It's really not real property. You're buying a stock certificate. Okay. There are no investment properties. Co-ops can be done as a second home. Only primary and second homes as co-ops. And that's it, my friends. There's no investment co-ops. There might be programs out there. I don't have them. But again, only co-ops. Okay. Let's see. Q&A. No, okay. Next. Basic income documentation. All right. W-2s, tax returns, both the business and the personal. All right. If you're a W-2 borrower, pay stubs, always need bank statements. All right. To show assets for the down payment, or sometimes you need to show reserves, which helps the file get, as I said before, that Fannie Mae, what's called DU eligible. All right. Sometimes you need reserves to get that done. Some other documentation, KYC, know your client. Obviously, you need social security card, driver's license. You're going to need disclosures ordered. All right. Sometimes we need more stuff. There's always LOEs for credit explained. Everything else is the same. But again, always full documentation of income, team. That's a conventional loan. It's based on full documentation of income. Full documentation is the foundation of that. Okay. Quick definition of occupancy types. Primary residence, a property that will be the borrower's primary residence, and they will live there for a majority of the year. Okay. You might have a New York snowbird team, somebody that goes from up north to down south to enjoy the warmer weather in the winter. They usually have a primary and a second home, but they're spending 80 to 90% of their time in that other state. All right. Now, the other home they may go to, for example, we have a lot of New Yorkers that go from maybe North Carolina, Florida, Georgia now is getting pretty popular, Tennessee. They migrate to the warmer weather. That could be your second home. All right. An investment property, something strictly for income. You do not even live there one day a year. You use strictly for generating income. There is no living there at all. So that is a investment property. Okay. Last slide, team, is me and my mug. So if you guys need to get in touch with me, you can take a picture of that with your smartphones. This little QR code here, you click, you can go on there. I see no questions. So I see everybody's an expert here. It took me 23 years. You guys got it in 28 minutes. Good for you. But on a serious note, guys, if you have any questions, bring me the scenarios. I'm available via email, text, the whole line. You'll see all of my information pop up when you hit this little QR code. I don't know if you can see my mouse, but that is a way to, you guys can get in touch with me. You know what I mean? If you're on the West Coast, it doesn't matter. Give me a shout. Sometimes I answer, sometimes I don't. For most of the part, I do. If it's later at night, obviously I'm sleeping. But again, team, don't hesitate to ask any questions. With that being said, going once, going twice. If there's no questions, I'll bid everybody a good night. Thank you all for signing on. Look forward to seeing you all next Monday when I'm going to go over VA loans. Okay? Speak to everyone soon. Have a good night, guys.